Now, just some questions that I had relating to capital gains was Erica, just minimizing capital gains, we've covered that. Robbins, we've covered. Jim, both my wife and I are over 70, still satisfy the eligibility criteria. We intend to liquidate our properties. Yeah, the only thing I think here, Jim, was the property will sell for around $400,000 and the gain is about $300,000 because you've held it for 19 years. What is the most tax-effective way of handling the excess over the allowable contribution limit? Well, it's the strategies that we just talked through. Either a deductible contribution or salary sacrifice, or a combination of both depending on what your scenario is. The unfortunate thing is that if it's held jointly, you've got a gain of $300,000 that you'll have to divide into, so that'll be halved to $150,000. $75,000 will need to be added to each of your taxable incomes, so you're only going to maximum amount you could potentially reduce your taxable incomes to is like $50,000, so you'll still pay a fair bit of tax on that amount, particularly because of the reduction in the concessional contribution threshold. So Keith was asking the question, so you can draw down a TTR pension and immediately put it back into your super account. If so, you would be saving tax on the income of the super fund because it would be in pension phase rather than accumulation phase. Exactly, you've got it, Keith. Good point. No CGT on personal residence investment property only. Yeah, good point, Jeff. You don't pay tax on your primary place of residence, and you can actually, if you've lived in the home for 12 months and you move out of it and you lease it out, you can actually lease it for 6 years before you start to incur capital gains tax on that primary place of residence. If you move back in after that 6 years, or it's vacant for 12 months, then you can reset that 6-year period again, and so refresh it and let it out for another 6 years after that.